Welcome everyone today. Today we shall be covering the topic of candle analytics, wherein we shall study hammer, which is one of the most widely seen candlestick form in the markets, but often interpreted wrongly and traded in a wrong manner. So today's aim is not only to understand what is candlestick form of hammer, but the most important part is when to use it, how to use it, and how to identify it. And last but not the least, when to ignore it. Yes, when to ignore it is a very important point. As you can see, usually how hammer looks. So first let's understand. It's a form of bullish reversal pattern. So when this term strikes us, bullish reversal, this should give us a hint that bullish means upward. It's fine. But when the word comes down as reversal, that means the market needs to be trending downwards and this pattern needs to form. Then only it can spark a reversal. So as this peak shows a Y-shaped formation, I'm trying to give everyone a hint that if you see a hammer being formed in a falling market, that's the first confirmation that this is the hammer pattern which you are at least going to consider. Now, how you can define it to understand it? It should have a negligible wick or shadow on the top. Or in other words, as it is written, it should be of a little size. This is mathematical representation that top 1/4 of the range the price should close off, and the lower shadow should be at least 2 to 3 times of the length of the body. So if you multiply this by 4, should be the length of this wick. But let me tell you, market is always going to show you anomalies. To break down the word anomaly, I would say market is always going to show you non-equilibrium conditions, and that what is going to give you opportunities to trade. So when I say that non-equilibrium conditions will exist, that means this hammer definition which is written over here is not always going to be found in ideal conditions. It could be small hammer with a little bit wick, with not a long wick like this, but a smaller wick. So that doesn't mean you need to ignore it. No. The importance is you should find the declining prices and then there should come a hammer. This is the most important takeaway. So now when the market opens, seller takes control in a downtrending market, and if the prices are pushing continuously lower, then only we can term it a downtrending market. And markets are not going to continuously fall. That is where some of the group of buyers or institutional buyers come into the motion, saying that we don't think so that the prices can go lower than this, or they should have their accumulated interest, and they start buying in a downtrending market. Mark my words here. Please pay attention to this format which I'm trying to tell. The markets came continuously falling down, and there these buyers accumulate. Okay, the market is going down, the sells are on, the buyers come in, forcing a group of buyers being held here, and then the market tries to consolidate and then slowly rises up. Only in this condition you are going to consider the hammer. And this is what gives birth to the pattern named as hammer. That's why I would like to bring to your confirmation that if you find the candlestick pattern hammer in a downtrending market, then only consider it. It also signifies now the lower prices are going to get rejected because buyers have taken control. Coming to the second important part, as I said, in a downtrending market, you find a hammer. So some of you will immediately think, fine, after struggling a lot or continuously seeing the charts day and night, I found a hammer and it's time to become a buyer now. No, it was the part one of the plan. Identifying hammer in a downtrending market was part number one. Now, whether the markets will reverse immediately or not, you need a confirmation for it. And what's the confirmation you need to look out for? Let's analyze this particular chart to find what I am trying to explain you. The markets are going down, down, down. Okay, they went up. You see a sudden rally, downtrending, breaking all the levels, and you find a hammer here. Okay, as of now, we will not pay attention to this 200 EMAs or which I have drawn. Let's just focus that you are monitoring these markets and you found a hammer. So your part one is completed. Now the part two which comes into action is identifying the confirmation. Usually what it is termed that if a hammer is formed near 200 EMA, because psychologically it's a belief of traders that 200 EMA acts as universal support if the price is nearing above it, and vice versa, universal resistance if the price is downtrending below it. So now when I say we need to add a confirmation that a hammer has been formed near 200 EMA after continuously following markets as shown here, this is what I'm trying to say. Use confirmation steps. Immediately you see a hammer, don't just buy it. Same time, you need to go at the background and see have the prices reacted well beyond that levels. You can see yes, there was a spike in buying. When you go beyond, you can see yes, there was a rally initiated. In the past, you can see there is a rally initiated. At the same time, you can also say that yes, the price did fall down. But how to come out of this confusion glitches? Right now, you are trading the prices which are above the hammer. That means the buyers are telling no more selling. And this is how you confirm this is the right hammer for you to trade. So this was my effort which I wanted to bring in format of hammer, identifying it, when you want to understand which is the right hammer for you, and confirming it before trading it. Stay tuned for upcoming events. Thank you.